Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 20 minutes. We don't have a lot of positions on that are active per se. We did get out of the IWM trade, which was a bearish trade. We did all of our earnings play trades have already played out. So we're going to just look at the SPX, and we talked about this a little bit on Friday. We looked to get bearish in the SPX. Now, I mentioned on Friday that maybe we should wait, or well, a lot of times we will wait until Monday to have a 1 week trade in the SPX, but obviously we probably shouldn't have waited, right? The market is down once again from headlines, mainly from out of Washington. And we're just going to jump right in and we're going to set up our put butterfly, and it's going to be an open wing put butterfly. So in this instance, we're going to go 20 points long. So with the market at 56.56, well, that's fun to say, 56.56. We're going to go down a little bit and buy the 56.50s, and then we're going to move 20 points lower, and we're going to do the 56.30s, and we're going to do that 2 times. And then we're going to go down 15 points, and we're going to buy this one. All right, so because vol has spiked.
Could you share the screen again, Brian?
Say it again?
Could you share the screen again, please?
Oh, okay.
Thanks.
All right. Well, now we're back. So in this instance, since the vol has spiked in the VIX, it makes butterflies in general cheaper. With a butterfly, what you'd like to have happen is you like to have implied volatility be high. And then if you're correct on your forecast, you want implied volatility to come in. So in this instance, when you're doing put butterflies, it's a little bit tougher than call butterflies, mainly because of the volatility situation, if you are correct on your forecast. With puts, obviously, when the market goes down, implied volatility has a tendency to go up. So on the call side of things, when the market goes up, if you're going bullish and using call butterflies, obviously implied volatility has a tendency to go down. So when you're initially putting on your trade, the higher the implied volatility, the cheaper the butterfly will be. So right now we're looking at, we're going to go out to the March 4th expiration. And we're going to buy the 56. Now it's 56.53. We'll do the 56.50s. Sell 2 of these. Got to reset this thing here. And then we'll buy this one, sell 2 of these, and go down to the 15s and buy 1 of those. And so now we can get this trade done for about $2.50. If the VIX was back down, let's say around the 16, 17 level, which used to be the norm, recently 20 VIX has been the norm, but on a 200-day moving average basis, the VIX likes to hang out right around 15 or 16. And it's always mean revertings. In other words, implied volatility usually settles down and goes back to where it was. So in this instance, if the VIX was trading down around that level, you'd probably pay $3 or $3.25 for this trade. Now we're able to get it done for, well, it's all over the place because the market's flying. So we got to officially make this move. But we're going to say, oh my gosh, look at the way the market's flying. 260, 275. We'll say 260. Let's go 260 for $2.60. Now I'm going to send it over to the what if calculator. And this is literally going to be our trade for this week. It's hard to get bullish, obviously, in almost anything. You can try to find things that aren't affected by the tariffs and everything else that's involved with all the headlines that are coming out of Washington. But ideally, I just kind of want to look at the markets. I'm going to take a peek at the IWM today once again, because I'm still thinking about going back and doing the long straddle in that position. But if we put this trade on, and I'm going to highlight right here, 230 is the maximum it trades for if we blow through our strikes. So if we go down and we end up, we don't get, I mean, I would expect to get a little bit of a bounce after today. I mean, the markets are really getting oversold at this point in time. Might be rightfully so. But with that said, I do expect some type of bounce to the upside. If not, that's all right, because if we blow through our strikes to the downside, because it's an open wing, because we have a long spread that is 20 points wide and a short spread combined to make our butterfly, and the short spread is 5 points wide, the difference between those two is $5. If we pay $260 on this in this instance, that means we could make $240 if the market went down. Now the market's moving; it's showing at $230 right here, but the difference would be $5 minus what we paid for it. And I'm struggling a little bit today. Well, got a little bit of a cold and my voice needs to hang out, but this is where my trade's going to be. So let's look at the setup again. This is an open wing butterfly. Market's at 56.59 right now in the SPX. We're going to go about 5 points out of the money. We're going to go out and do the Friday expiration, which is March 4th. We are then going to buy the most at the money option contract, which is the 56.50. We're going to go down 20 points to the 56.30, and we're going to sell 2 of those, and then we're going to go down 15 points, and we're going to buy 1 of the 56.15s. We're going to get this trade done for about $2.60. That's going to be our max risk on the trade. There's no more additional margin. So $260 per 1x2x1 open wing butterfly that we put on. And if the market does come back, what we'll end up doing is we'll roll this into a short put spread. So if we do get some momentum to the upside, which is very feasible in this marketplace, one news headline can turn sentiment quickly. And if we do get that move to the upside, what will happen is we'll sell the 56.50 and we'll buy back one of the 56.30s. So we're going to sell the most expensive one, the one that would be closest to the money, and we'd roll this into a short put spread. Now, when would we do that? Well, right now, if we look at the spread that we would be selling to create the short put spread, it would be selling the 56.50 and the 56.30. Okay, so let's get rid of the 56.50, 56.15. That one's gone. All right, 56.50 and 56.30. Then if we flip that around, this would be a sell, and this would be a buy. So right now it's a net credit of $850 to the account. All right, so it's $850 right now. If that credit comes down and gets down to about $5 or $4, right? We paid $250 for it. So you got to realize you're going to be bringing on more risk. But if you see the spread trading south of $5, I want to think of that means that the markets came back. That means the market's gone up, correct? In this scenario. So think about that. If the market goes up and you see the spread trading for less than $5, we then will roll into a short put spread, which will have $1,000 requirement or $1,500 because we're 15 points wide, which will have a $1,500 requirement in this scenario. And this is our adjustment. We would adjust either more likely on Wednesday if we need to, but if the market came roaring back tomorrow, well, then we would look to adjust on Tuesday. if we can do the trade. But this has to go down in credit. In other words, we need the market to go against this spread. And then let's say we got it done for, let's call it $4. We would have $1.50 credit to the account. The market would be trading somewhere around 56.90, maybe even 5700 for that to happen. And when that happened, then we would be short a put spread, and we would have a smaller net credit than if we put it on to begin with, but we would have about $1.50 net credit in the account. And that would be our adjustment. Now, there's a different adjustment that we can do, and we'll talk about it maybe on Wednesday if the market does come roaring back. But at this point in time, there's a lot of weakness in the market. I don't see anything to stop it besides news headlines coming out of Washington. I mean, that's really what's creating a lot of the panic right now. And so I want to stay short the market. And with implied volatilities as high as they are, an SPX open wing butterfly makes sound sense. Now, you could just do a straight out long put spread. I don't mind that at all. I definitely don't want to just be buying puts because implied volatility is so high. So it's a double whammy if you did get the bounce back as far as the marketplace would be concerned. If you're buying puts with high volatility, and you would get, the snapback in the marketplace. So either bear put spreads, which is a put debit spread, or I like my open wing butterfly. And also to go along with the open wing butterfly, it's a fairly simple adjustment if the market does come back and you want to turn this trade into a bullish trade. All right. Now, if you have any questions on that trade, feel free to put them in the chat box, and I'll try to address them. Now, the other trade that I am very interested in, and I don't know if I should pull the trigger now, but we've done this more than once in IWM, and here's the chart. I'm going to actually add a few more days. Let's add another 300 days onto the chart. Okay, so we did a lot of long straddles way back when the IWM, which is the Russell 2000 index, when it was in this strong channel from high to low, it was 165 up to 200. And this is about a month-long period that we had these wild swings. This one wasn't quite as big. We did a long straddle here, and I think we did one down at the bottom. We actually did one right here because I remember it didn't really work out for a minute, and then it came back and it started to work out. Okay, so if you're looking at this position, the market's at 203. It's coming down towards the 200 level. 30 days is probably going to be $13. I'm going to look at it, but I was thinking I'd like to buy it right at the top of these channels, and I actually have the dotted line kind of highlighted there as to where that point would be, and that's 198. Now we've obviously, here's where we got short IWM, is when we broke through the 200-day. We were about 217 on the IWM, and we did a wide bull put spread to the downside, and that obviously paid out. So now we're back to here to this level, which is also interesting. It's not quite as interesting through this area. A lot of chop in the marketplace, but up here on the higher end of the chart, we got, this is actually the highest end of the channel after the first draw up in the IWM. So now we're here down around that 200 level. Yeah, I'm real interested in getting long a straddle right here, but I'd like the marketplace. Ideally, now I don't want to pay for volatility, and volatility is really high. Usually 30 days is about $10 for an at the money long straddle in the IWM. Let's go look at it. I'm guessing it's going to be 13, maybe 14. So that was our official paper trade, and I'll put it here. I'll set up the what if calculator. This is the official paper trade in the SPX. And now let's look at the IWM trade and see what that is trading for. Look at like a 198. 198 going out. There's 14 days. I got to go longer. 21 days. A lot of expirations in IWM. So 32 days out. Maybe we just do 25. But if we go 32 days out, market is at 203. 203. The call is, trading higher than the put, quite a bit higher. And this is 32 days out, April 11th. And we're going to get rid of this. And we'll buy that one. And we'll buy that one. Yeah, now it's trading for 1428. That makes it tough. Oh, that's not even the right one. 204. Okay, there we go. 1382. Yeah, vol is up quite a bit, trading right around 27% implied volatility, which is high in the Russell. So I don't think the time is right. I think with the big downturn in the marketplace on a Monday, which always seems to happen on Mondays, the market, no real, I guess you can say you got all weekend for news headlines to hit, but it just always seems on that Mondays are much more volatile than the middle of the weekdays. So if we can get a little bit volatility to settle down a little bit, ideally right around 198 is the top of that channel, and then it's going to have to figure it out. IWM is either going to want to break to the downside into that old, really strong channel that it had back that was about 9 months ago, or it's going to bounce and take back, fly back to that chart, everything that it just lost on the downside. But these news headlines are really bad for small cap companies. As a matter of fact, I did a long straddle in my own account right around here, and I got out and I didn't do very well on it. I ended up getting out at close to even. But what happened was it ran to the top of the channel and I closed it. And then I didn't make anything on the call side of things. So or on the put side of things. So I basically got out at break even. I think I lost 50 cents or something. It just didn't move enough. But even in this little channel, it moved enough, right? 221 up to this high side is 230. So that's about 8 points. And if you put in the time premium, that means that you could have sold the call for at least 8 points if you bought this straddle down here, plus a little bit of premium because we were going out 30 days. Now, so even that move right there almost covers where the implied volatility is at right now. But definitely when we got bearish here at 217, now we're all the way down to 202. This channel here on the low side of things was, we'll call it 170 all the way up to the high point. Almost 200. Yeah, obviously that's where we're looking to do the straddle at. So that's 30 points in that range. So you just need one side to be right. And I like legging out of them. I prefer if I can make a couple of dollars on one side and you got some time, you can usually make more than enough on the other side. You're just playing with the house's money at that point in time. I don't like long straddles in general. I like long straddles when news events are driving markets. And I've mentioned this many times. One of when Boeing was having all the issues with their planes falling out of the sky, and even though it is sad that all that happened, the news headlines were hitting hard on Boeing and blindsiding Boeing left and right. Will the planes fly again? Will they ever fly again? Are they making what are they going to do with the MAX airplane? But that was a scenario where there were going to be news events. You just didn't know when. And that's when I'd like a long straddle. And I kind of feel the same way about this marketplace right now. And what the news headlines are doing to the markets and how each and every week we're getting blindsided with them. And in the small caps, that's one of the underlyings that is very susceptible to anything that can happen with inflation. That would be a bad thing. Obviously, just all the market and economic headlines seem to hit the small caps a little bit harder than they can on the big caps. But in this day and age, it doesn't seem like there is also everything is getting hurt. Mid caps are probably the strongest area to be right now. Big tech is also getting hit, so the big caps are getting hit also. Nvidia is a great example of that one. All right, any questions that we have? I feel like I'm rattling on. We're going to look to do this trade if it comes. We want vol to come off a little bit on the IWM, but our official paper trade for the week is going to be the open wing butterfly using puts in the S&P 500 index. And that's it for today's Options Guide TV. I don't see any questions or comments. If you do have them, you can also address them. You can do it via the hub.tradier.com. Watch it on the Tradier YouTube channel. Watch it on my Twitter. My handle is @BrianOverby, and also on the Tradier Twitter, or x.com. Feel free to share with your friends and family. This is a family event. We're more than welcome to try to address any of your questions during the show. And we'll see you this Wednesday for the next edition of Options Guide TV. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.